All right, let's pop the hood on a really interesting player in India's auto scene, Sandhar Technologies. Now, these guys make the kind of everyday parts you probably never even think about. But believe me, they have a surprisingly ambitious plan for the future. So, when a company that makes stuff like car mirrors and locks starts talking about growing 20% a year, you got to ask yourself, how is that even possible? Well, it turns out the answer isn't some single magic bullet. It's actually a pretty clever three-part strategy. It really just boils down to three things. First, they're absolutely doubling down on their home turf, that huge Indian market. Second, they're getting into more high-tech parts, moving up the food chain. And third, they're buying other companies to get bigger faster. Okay, so before we dive into where they're headed, let's just get a quick handle on what Sandhar actually does right now. You know, the first thing you have to get is just how laser-focused this company is on India. I mean, we're talking nearly 90% of their revenue comes from right there at home. This means their fate is tied directly to the boom in India's own auto market. And hey, it also gives them a nice cushion against all the chaos you see in global exports.
And they're not just making one or two things. They are deeply woven into the fabric of almost every vehicle. We're talking about everything from the locks you turn and the mirrors you check, all the way to the heavy-duty metal parts that make up the car's actual frame. Having that kind of product mix gives them a really solid base to build on.
All right, so that's the foundation. That's the business today. Now let's get to the really exciting part. How in the world do they plan to hit those massive growth numbers?
And look, this isn't just some analyst making a wild guess. This is coming straight from the horse's mouth, from the company's own management. They're not just talking about getting bigger, they're talking about profitable growth. They've set this really clear goal of getting their profit margins into what they call a safe double-digit range. Let's just zero in on that number for a second, 14 to 20%. That's their official target for revenue growth by FY26. Now, for a company that's been around, a manufacturer, that is a seriously bold number. It tells you a lot about how confident they are in their game plan.
So where is all that growth going to come from? Well, a huge piece of the puzzle is this. They just bought a die casting company, and that alone is expected to tack on over 400 crore rupees to their revenue. It's a classic move, right? You buy growth to scale up fast.
The other big driver here is technology. Get this, just one single smart lock for a motorcycle can bring in 10 times the cash of a regular old lock. This whole trend of premiumization is like a massive tailwind for them. It means they can make a lot more money from the very same car or bike. And they're also playing the long game with what you could call EV optionality. What does that mean? Well, they're developing really important EV parts, like motor controllers and chargers, to get their foot in the door. It's a brilliant strategy, really. It sets them up to cash in when EVs really take off. But their main business today doesn't depend on that happening overnight. It's a really smart, low-risk bet on the future.
Okay, but let's be real. No investment story is all sunshine and rainbows. We've seen the exciting growth plan, but now we absolutely have to talk about the things that could go wrong, the roadblocks that could really throw a wrench in the works.
And this is a big one. You have to pay attention to this. More than half of all their money comes from just two customers, Hero and TVS. That gives those two companies a ton of power. I mean, if either one of them slows down production or just decides to use a different supplier, bam! Sandhar feels that pain immediately, right on their bottom line. And then there's this other major issue. It's almost like a tale of two different businesses. Back home in India, things are running like a well-oiled machine. But their overseas operations? Yikes. They've been a huge drag on profits. They're getting hammered by currency swings, soaring power costs, you name it. Just getting those international businesses to stop losing money is a massive headache for them. And on top of all that, you've got the stuff that's just completely out of their control. Think about sudden spikes in the price of steel or aluminum. That can crush their profit margins, especially if their big customers drag their feet on accepting a price increase. Plus, if the global economy slows down, that could hurt the small bit of exporting they do. So, you've got the bull case, the reasons to be optimistic, and you've got the bear case, the reasons to be cautious. How do you actually keep score? How do you track if they're pulling it off? Well, we've boiled it all down to a super simple checklist for you. Honestly, you can cut through all the noise. If you want to know how Sandhar is really doing, you just need to watch four things. 1. Are their overall profit margins getting to that 10% goal? 2. Are they finally plugging the drain and stopping the losses overseas? 3. Is that new company they bought actually bringing in the money they said it would? And 4.
Are those little EV pilot projects turning into real big-time orders?
Yeah, just think of this as your personal dashboard for tracking Sandhar through FY26. It's simple. Can they keep those margins above 10%? Can they get the overseas business to at least break even? Will the acquisition hit that 400+ crore revenue number? And can they turn those EV experiments into a real business? The answers to these questions, that's the whole story right there.
So at the end of the day, Sandhar has a pretty clear roadmap and a powerful engine, right? It's fueled by that strong home market in India and some smart new tech. But the road ahead is definitely not smooth. It's got some serious hazards, like relying too much on a couple of customers and those struggling overseas units. So the big question is that engine powerful enough to get them to their very ambitious destination, or are they going to run out of gas somewhere along the way?